Welcome to the deep dive. Today we're going to peel back the layers on a company everyone knows, for one thing, Xiaomi.
But they're now making these huge waves in something completely different.
Exactly. And this isn't just about the surface level headlines.
No, definitely not. We're really going to explore Xiaomi's fascinating journey. We've got insights from, well, all sorts of places.
Yeah, online investor forums, tech market analysis, business reports, financial forecasts, a real mix.
Right. And our mission really is to understand how Xiaomi managed this. I mean, they faced pretty big challenges in their core business just a few years back.
And now, an incredible comeback in smartphones.
And at the same time, this really audacious leap into electric vehicles. High-stakes stuff.
So we'll explore the risks, the rewards, what it all means for them, and importantly, for your understanding of these big global tech shifts. Let's unpack it.
Okay, so to really get a handle on where Xiaomi is now, it helps to look back, look at the foundations and past hurdles.
And the view from investors is a great place to start, right? That Hong Kong Geo-Expat Forum gives such an unfiltered look.
It really does. You see how everyday investors are thinking about Chinese and Hong Kong stocks, and right away there's this real contrast.
Yeah, like that user Sammy Lee sharing this list they called exotic and speculative, lots of lesser-known companies.
Definitely on the adventurous side. And then you had others like Shri and Train Investor, much more conservative, focused on dividends.
And the concerns raised about Sammy Lee's picks were quite specific, weren't they?
They were. Things like, little public knowledge about the firms, really low market caps.
And some operating outside their main business, like that telecom company with a weird investment arm.
Exactly. Plus, several were losing money. Not just losing, but the losses were getting wider.
It really makes you think, as an investor, how much risk you're actually comfortable with.
It does. And you saw that cautious approach with Train Investor. They called themselves a retiree, favored boring dividend-paying shares and index funds.
But still kept a little aside for speculation.
Right. Mentioned Shuntalk trading way below its asset value, its NAV.
And Rosedale Hotel, too. Huge discount, loads of cash, even though it was losing money.
Yeah, and someone else, Freer, I think, even suggested an activist approach for Rosedale, like push them to give that cash back to shareholders.
Interesting. And then you had others, like Victory, worrying about corporate governance with individual Asian stocks.
That's a common theme. They preferred options on ETFs instead. So, a company operating outside its core competency without a clear reason, that's often a red flag. Makes the future much harder to predict.
Okay, so that's the investor backdrop. Now, Xiaomi's own journey. It wasn't exactly smooth sailing either. That KR Asia report highlights 2019 as their golden age.
Yeah, big ambitions then, aiming to be a high-end international brand.
But fast forward to 2022, 2023, things got rocky.
They really did. And there's this fascinating contradiction. The CEO, Lei Jun, he publicly vowed to challenge Apple, become China's top high-end brand, said it like a dozen times at one conference.
But then the products didn't quite match the ambition.
Well, the flagship Xiaomi 11 series had some serious quality control problems. Overheating, Wi-Fi issues, even power failures.
Ouch. That's not very high-end.
Not at all. It led to this flood of complaints, and the customer experience was poor too. Only motherboard replacements offered, no exchanges.
Wow. For a company trying to go premium, that must have been a massive blow. How did it affect them?
Oh, it was bad. Really hurt sales of later models, damaged the brand's reputation significantly.
It really makes you ask what high-end actually means, beyond just talk.
Exactly. It needs flawless execution, tight quality control, great support, and the numbers showed the hit. Q3 2022, revenue down almost 10% year-on-year.
And profits.
Adjusted net profit dropped sharply, like 59.1%. The smartphone business itself, revenue down over 11%.
So the paradox was their strength, their bread and butter, was the budget-friendly Redmi line.
Right. Super popular. But that success kind of held them back from being seen as truly high-end.
Stuck between a rock and a hard place, it sounds like. So how did they start to turn things around? Break free from that budget label, but keep the Redmi crowd happy?
It's a classic problem, isn't it? But it looks like they leaned into what they do really well. Ecosystem integration and value.
Which brings us to the comeback.
Exactly. The comeback kid in smartphones. That Canalys report for Q1 2025 had some pretty exciting news.
Yeah, the whole smartphone market in mainland China grew 5%. Nearly 71 million units shipped, helped by subsidies, better consumer feeling.
And the big news. Xiaomi back on top, first time in a decade, shipped 13.3 million units.
That's huge growth, 40% year on year. giving them 90% market share.
Incredible turnaround. Huawei was close behind, Oppo and Vivo third and fourth. Apple actually dropped to fifth after their usual Q4 peak.
So what did Canales say was behind this win? What was the magic?
Well, a couple things. First, really effective synergy across their different ecosystems. Smartphone, AIoT, that's artificial intelligence of things, and now mobility.
Okay, the ecosystem play.
And second, consistent pricing. Online, offline, same price. Which apparently made it easier for people using those subsidy schemes, less decision friction, as Canales put it.
Makes sense. Keep it simple. And the Finance Ties source digs into the financials behind this, right? It's quite revealing.
It really is. It shows that smartphones, they bring in the most revenue, about 52%.
But the profit margin isn't great.
Relatively low, yeah. Only about 12% gross margin.
Okay, so where's the real profit coming from?
Well, IoT devices, they're 28% of revenue, but with a better margin, 20%.
Better, but not amazing.
But here's the key. Internet services, only 9% of revenue, but the gross margin is massive, 76%.
Wow. Okay, so that reveals the strategy.
Totally. The smartphone is like the front door, get people in, get them using Xiaomi phones.
And then sell them higher margin services and connected devices, the ecosystem.
Precisely. It's all about that broader ecosystem.
They call it Human X Car X Home, right? Connecting you, your car, your smart home stuff.
Yeah, aiming for that seamless connection. Imagine, your phone tells your house to warm up as you drive home, or your car talks to your smart speaker.
That integration is the unique selling point.
And it ties into their whole technical cost-effectiveness approach.
Explain that a bit more.
Well, they aren't always the first to invent something, but they're incredibly fast at sort of copying and developing existing tech.
And then offering it with high specs, but at a lower price. Better value.
Exactly. Better value for the consumer. It's a smart play.
And they're not slowing down, aiming for 180 million smartphones in 2025, up from around 168 million.
And opening 10,000 new Mia Home stores outside China in the next 5 years.
So sticking with that integrated ecosystem, that value strategy, it makes their next big move maybe less surprising, but definitely audacious.
You mean the leap into electric vehicles?
The EVs, yeah.
Definitely audacious. CEO Lei John calls it his top priority. It's a huge gamble.
Especially considering the car business was losing quite a bit of money back in 2022. Hundreds of billions of RMB each quarter.
They pushed ahead anyway. And the latest numbers from LTMH show the scale. Q4 2024 EV revenue was 75.7 billion baht, about $2.1 billion US.
With a decent gross margin, actually, over 20%.
Yeah, for the quarter. Full year 2024, revenue hit 149 billion baht. That's roughly $4.1 billion US, margin around 18.5%.
But even delivering, over 136,000 SU7s?
They still posted a big loss for the EV business in 2024, 28.8 billion baht, around $800 million US.
Those are serious numbers, yet they seem confident.
Incredibly so. They've actually raised their 2025 delivery target from 300,000 up to 350,000 EVs.
And planning to export by 2027.
That's the plan. Shows real confidence, especially entering such a tough market.
All right, analysts call it a red ocean. What does that mean exactly?
It's a term for a market space that's already crowded, where competition is fierce, cutthroat even, companies fighting hard, profits often get squeezed, bloody.
And China's EV market fits that description.
Perfectly. Hundreds of brands, they say. Everyone expects consolidation, leaving just the big players like BYD, Tesla.
So Xiaomi's coming in as the newcomer, less experience in actually making cars.
That's a major challenge. And then there's the tech itself, like autonomous driving. Safety is paramount.
Yeah, you mentioned some recent drama, incidents causing stock drops.
Right. Unforeseen issues with self-driving tech led to significant stock price falls, maybe 5–7% for some companies involved. It really highlights that tension, doesn't it, between pushing development fast and making absolutely sure it's safe.
A critical balancing act.
Yeah.
And beyond EVs, they're also pouring money into AI.
Huge investment there, too. Up to 37.2 billion, that's about $1 billion US planned for AI projects in 2025. It's roughly a quarter of their entire R&D budget.
Okay, so bring this all together. What does it mean if you're looking at Xiaomi as an investment?
Well, analyst sentiment seems positive. TipRank shows a strong buy consensus. 12 analysts, average price target $8.75.
Which is what, about a 27% upside from where it is now, with a range from around $7.60 up to over $10?
And financially, they've been beating expectations pretty consistently. Earnings estimates 75% of the time, sales estimates 100% of the time over the last year, outperforming their industry.
But that price-to-earnings ratio, the PE, is high. around 50, 51x.
It is high, and that reflects the market's really big expectations for the EV business. That's what's expected to drive the future growth. The high TE is basically betting on massive growth ahead.
So if that EV growth doesn't quite hit those massive expectations, that high valuation could be a risk.
Absolutely. The market has priced in a lot of future success already, so key things to watch.
First, can they keep their grip on the core businesses? Smartphones, IoT?
Crucial. That's still where most of the revenue comes from, remember? 52% from smartphones. They generate cash there. 58% revenue from China. 41% international. Need to maintain that base.
Right. Can't neglect the foundation.
Definitely not. Second, the EV success is paramount. It has to deliver to justify that high valuation, to give that growth that feels worthwhile, the kind that makes the PE look more reasonable if growth is, say, 100% or more.
Okay. Core business stable, EV success needed. What else?
What?
Macro factors.
Macro headwinds, yeah. For investors using depository receipts, DRs, there's some hedging against yuan-bought currency swings. Fundamentally, the yuan tends to strengthen because China runs a big trade surplus.
But isn't there talk of the government potentially pegging the yuan to the dollar for trade advantages? That sounds complicated.
It is. A stronger yuan helps your investment value in other currencies. But government policy could limit that gain for strategic trade reasons. It's a constant push and pull.
And debt. I hear concerns about China's debt levels.
Yes, the undisclosed debt, especially local government debt. If you factor that in, China's overall debt looks much closer to U.S. levels. The big question is, can they keep generating enough trade and revenue to manage it all? What happens if they can't?
Potential instability there. And then government policy risk itself.
Always a factor in China. We saw what happened with Alibaba, for example. Now, Xiaomi being listed in Hong Kong might offer a little bit of insulation compared to a mainland listing, but it's still something investors need to be aware of.
It really sounds like this tightrope walk between huge potential and significant risks on multiple fronts.
That sums it up pretty well. And speaking of expansion, it's interesting they're looking at potentially building EVs in Thailand.
Driven by Thai government policies and strong EV demand there.
Seems like it. It could open up new regional markets for them, spread the risk a bit, grow that global footprint.
Shows they're constantly looking for new angles, new opportunities.
Very adaptive, very ambitious, always pushing that ecosystem concept further.
So wrapping this up, Xiaomi really presents this fascinating duality, doesn't it?
Totally. On one hand, they've shown resilience, strategic smarts in their core phone and IoT business. Proven they can compete and win there.
Mastered that technical cost effectiveness.
Right. And on the other hand, they're taking this massive, risky bet on EVs, trying to apply the same playbook to a much tougher, more capital-heavy industry.
Which leaves us with a final thought, maybe. How does a company like Xiaomi balance being known for cost-effective products while aiming for that high-end status, especially when jumping into something as competitive and expensive as EVs?
It's a huge question. And what does their journey tell us about innovation, about risk-taking, and maybe about the future, where everything connects your phone, your home, your car, all speaking the same Xiaomi language, perhaps?